Hey everybody, welcome to the Jay Young Show, and I'm Jay Young, and today we have a very special guest, Jordan Kimmel. Jordan is the founder of MagnetInvesting Insights. Jordan has spent years helping both institutions and individual investors navigate the stock market with clarity and precision. We're going to learn a lot. This is really a great deal. This guy's brilliant. He's figured it out. He's figured it out. We're gonna learn more about that. He co-created the widely respected magnet model and the fax model, which we're going to learn about today. But they're both being used by major institutions to make informed, data-driven decisions. Today we'll dive into his career and also his unique approach to stock selection and get his insights on the current state of the market. Let's get started. Jordan, welcome to the Jay Young Show.
Jay, it's fun to be with you. Glad to be with you, and let's get started.
Man, let's do it. Let's do it. I want to learn. Let's kind of go back and something that you. How did you begin? How did you begin in the markets, or where did you go to school? Kind of give me some of your background and then your career, and then we'll go into. We'll definitely get into magnet investing real soon.
Sure. Sure. Well, let me say, Jay, I have a unique background which kind of put me right into this situation. And what I mean by that is I grew up on Broadway in Manhattan, overlooking Broadway. My parents had a little dress shop right downstairs. Literally, they took the elevator to work. And as the youngest of four kids, I look back, Jay, I don't know how they supported four kids out of this. We didn't have a lot, but we had each other. It was really a nice, nice childhood. But what happened would be, my parents would sit around this table, the six of us, and they talked business a lot. And they talked about how much they sold today, how the store did. And they were both small time investors, but frankly, they were infatuated with it.
Hmm.
And Jay, the story I tell in all three of my books, it's a funny story. I had two grandparents. One set of grandparents, loved them both, no doubt. One pair, you'd go to their house, you get two pieces of white bread and one piece of cheese, and that was lunch. And the other set of grandparents somehow had this car full of toys all the time. That grandfather was retired. He had been in the market for years. And I said, man, what market? The stock market? And I asked as a little kid, Jay, no kidding. I said, I used to eat a hamburger, I think, every night for dinner. And I said, hey, is this Heinz ketchup? Is this a public company? Can you invest in this? And at 8 years old, I took my accumulated life savings of allowances, birthday gifts, and what have you, and we bought some Heinz shares. My parents bought it for me. And I love the stock market, basically, from the very get-go, the idea that you could buy into somebody else's company that has thousands and 10,000s employees and you can share in their profits. That was a pretty cool story. And that was my actual first trade, 8 years old, Heinz ketchup. I was about 50 years ahead of Warren Buffett and his purchase of Heinz.
Wow, that is awesome. That is awesome. And what a great product. I mean, what a great product. That product has been around obviously for forever. The bottle, has the 57 where you can get it out of the
There you
bottle.
go.
They tried new things, but talking about a product that you can scale, man, that's a great shot. Great
It's a
job.
great story, and,
Yeah.
and and so let me share one more piece here. So, in my neighborhood, Manhattan, right now, this area is very glitzy. The area I grew up right now looks nothing like where I grew up. I was lucky enough to be admitted into a school, Jay, called the Bronx High School of Science. And I think my parents were happier than I was because I had to take the train 1 hour to the Bronx. But this school, Jay, is probably considered one of the top schools in the United States. It's free to get into if you pass the academic test. And so I went there for 4 years. And the reason I bring that up is I was exposed, Jay, to something back all the way back then called the bell curve. Very simple concept. But if you measure literally anything from a human being's height to their width of their hair to heights of buildings,
Mm-hmm.
when you take a list that's big enough, it becomes normally distributed.
Hmm.
And almost everything is average. And on the tips of the bell curve, there's excellent and there's really bad. And I said, why would anybody buy the whole stock market? Why wouldn't we use some math, find out what makes a great company, and then actually solve and only invest in the tip of the bell curve? That got me started all the way back in high school, and I was trading options in high school, and I did pay for my own college. So I'm a self-starter,
Wow.
but this concept of owning businesses and being able to solve for the best one has now been in my blood for over 50 years.
Wow. That's amazing. That's awesome. So did that help you start um, Magnet Investing Insight? What is Magnet Investing Insights? I guess what's a good definition?
So let me get into that. It's
Yeah.
really a fascinating story. So,
Yeah.
so the thing is, I was always buying and selling stocks in high school and college. It just really interested me. And then I said to myself, it's time to go to work. My first job out of school, Jay, was working for the mayor's office, the Office of Management and Budget in New York City. I had a very big money line assigned to me. It was Department of Transportation, Sanitation, some great groups. And I learned a lot about organizations there. But Jay, they said to me, we're going to make you the youngest commissioner in New York City history. And I look back, and a lot of the people there were either very wealthy and they were there for the power, or they were there for the power which they were going to use in the future to make money.
Mm-hmm.
And the mayor himself back then was making $110,000, and I'm saying, Commissioner, no, no, thank you. And I went right down to Wall Street. I didn't know anybody there, but I went down to Wall Street and I started selling municipal bonds. And, to wealthy people, it wasn't very risky. You just had to get on the phone and sell.
Mm-hmm.
And Jay, every $5,000 I accumulated and saved, I bought another stock. With that stock, rather than leave it at the brokerage firm, I literally put it on the wall in my home on dividend reinvestment. And then about 3 years, 4 years into working at the mayor's office, I said, can't do it. Went down to Wall Street. I sold a lot of what Wall Street was talking about. And again, they push stocks, they do investment banking, they get involved. And I developed my own method. It's called Magnet. I'll get into the acronym, what it really stands for. But the point is, it was all about solving for the tip of the bell curve and to look for the fastest growing, best companies to invest in. And I haven't stopped.
Wow. So it is like a Warren Buffett. It is like a Warren. You are the Warren Buffett, or you're looking at all these different companies. And I remember back in the '80s, I got my Series 7 in the '80s, and I love the stock market and
Okay.
all that. And we got the big value investing, publications, and they were thousands of stocks. It's so much easier today. I can't imagine with AI and having to, just ask questions like this and you get answers compared to what we had to do a long time ago, and especially you too, because you're studying stocks and you're studying, I mean, printed information from quarterly reports and how did you? So what were you looking? Was there anything in particular? I don't know
Well,
if you're gonna give me your secret sauce or not, but
yeah,
what were
I'm
you?
going to give it to you, man.
Yeah.
I'm going to give it to you, Jay.
All
I'm going to
right.
give it to everybody. And
Hey,
it's actually
only on the
in my
Jay Young
book.
show. Only on the Jay Young show, Jordan. You're gonna
Well, it's
let it
actually,
rip.
I'll give you a secret. It's actually in my book. And
Oh,
I said,
okay.
don't be afraid to share it. It's so hard to do. But here's what I basically did, Jay. And here's kind of the fun story. What I used to do is I would go to these conferences, places called the Money Show. I'll be speaking at next one's Money Show in Las Vegas next week. But I would sit in the front row, and then as soon as the opportunity came, I'd ask the speaker, "Can I take you to lunch or dinner? I just want to ask you a couple of questions." And the questions always were, what makes your style different? And what two books would you read to really understand the market better?
Wow.
And what there were, Jay, there were some value investors, there were growth investors.
Mm-hmm.
Uh, a new spring of investors showed up called momentum investors. And I'd say, what do you look for? What do you look for? And then what do you look for?
Mm-hmm.
And as luck would have it, again, remember when this was. I was getting some information by faxes, which we now get, by internet. And you go all the way back. Warren Buffett's mentor, Benjamin Graham, had to do this at the library on the weekends. So you're 100% right about the data. So what we did was I came across all of these different things, whether it was revenue growth or margin acceleration or the amount of debt that you had or all kinds of factors of value growth momentum investors did. Now, luck would have it, paid for my own college. I went to the University of Stony Brook out on Long Island. And as luck would have it, who was there? It was actually Jim Simons, who became the most successful investor basically in the world, and his merry men of mathematicians.
Hmm.
I don't know if there was any women back then. So what happened was when I got out of the mayor's office, I said, I'm going to start my own company. I went back to Stony Brook, and it turns out that the founder of the business school is a physics PhD that studied chaos theory. He said, show me what you're talking about. I heard you have a model. He ended up building the macro, which continues to run today. And he said to me, Jordan, I think you have something. I think we could sell this to Wall Street. Within a couple of years, Jay, we actually licensed this out to John Nuveen, which has, trillions of dollars under management.
Mm-hmm.
It's been not smooth riding ever since because the market changes. The model isn't perfect. Nobody picks all winners. But with all these years of using the data, understanding the model, uh, that was the origin of it. It has to do with the fact that it's not a matter of value, it's not a matter of growth, or it's not a matter of momentum. What if we could do the math and insist on all of those things being present? And people would say to me, how many companies have value, growth, and momentum? You're looking for, a bone in the stack.
Right.
And I'd
Right.
say, fine, I don't want to invest in the whole market. I only want to invest in 5, 10, 15 companies at a time, the ones on the tip of the bell curve. And that was Magnet. We run managed accounts for individuals right now who are not institutions who want to be in Magnet. And this is all something that I've worked on. Jay, let me also point out for a minute, I didn't do this myself. We had a team of PhDs that Dr. Owen Carroll assembled. I had interns every summer from Stony Brook, from Harvard, from city
Hmm.
colleges, from local colleges, and we built this model from the way up. And you know what's interesting? In 30 years of running it, it's barely changed.
Well,
All we're looking for is the companies with the highest revenue growth, profit acceleration, and there's 19 factors, and every single one of them are in the books behind me.
wow, unbelievable. Value, growth, and momentum. I think I heard those three words. So how do you find some? I mean, how many thousands of stocks, or how do you pour through these to find out? I mean, obviously, every stock that's out there. I mean, if you have an IBM or
That's
Apple
the
or
answer.
whatever, you have a value, right, and a stock price, and then you look for growth. How do you know that there is going to be growth in that particular industry? How do you
You
measure
don't.
that?
You don't. It's really, this is a great question, Jay, and you don't. And the thing is, there's a lot of things you don't know.
Mm-hmm.
And anyone that tells you that they know exactly the way the economy is going to go, they're charlatans. They don't know. There's too many variables. There's too many things that come up. But we talked to Drop before we went on air about sports, and the whole idea is if you were looking at football teams, or the Super Bowl just ended, but if you had a football team that had better than average offense, better than average defense, better than average special teams, well, you're not going to win every game, but you're going to win a lot of them. And in the investment business, you don't have to win on every investment either. The
Mm-hmm.
whole secret is to cross the model. Once you actually find a company that makes your model, then we do some secondary, third. Why is the revenue growing? Is there a new product? Was there a one-time lawsuit? You have to ask the questions why. We'll put that stock, we'll call it, into our lineup,
Mm-hmm.
and we'll start small. If it begins to work out, we'll add to it. If it doesn't continue to grow its revenues, if the margins start to decline, all sorts of factors, we simply rotate out of the stock. So when you think about going back to sports again for a minute, whether it's football, baseball, basketball, whatever your sport is, you know that there are statistics in baseball as a game, I know you know very well.
Mm-hmm.
If you have higher, it's the five-tool athlete. If they could hit for average, if they could hit for power, if they have speed, if they have an arm, play defense, we don't have to think that much further. That's exactly what we're looking for. And I equate it, Jay, to students. If I only have A and B students, given enough exams, they're going to beat the universe of all students, including the C, D, and F students. So it's just a matter of doing some math. And when you ask how many companies, Jay, the answer is all of them.
Mm.
Through the computer, through the macro, we just run stocks, and then we divide them, obviously, into by sector and then by market cap. So we're really comparing, say, an oil and gas company of one size versus an oil and gas company of another size. If that same example has higher revenues, higher margins, higher cash flow, less debt, institutions buying, and some momentum behind the stock, you don't need to really overthink it. What do you think?
Right, right. You just got to do your research, right? I mean, that's a lot of research. I mean, that's a lot of research and staying on top of it. And is Chat GPT, all that stuff, AI, is that really helping? Is that helping a lot more? Because does it take a lot of the emotions? I guess there's a lot of emotional, people thinking. Does that take a lot
Right.
of it out?
I think you're hitting on something really important. The whole intent of Magnet is to eliminate as much emotion as you can.
Mm-hmm.
Now, this chat just came on board, and I actually am intrigued. Uh, I use it to some degree. I don't use it to predict stock prices. My data is as complete as any data because we're buying all kinds of data from all kinds of services. So we know we have the numbers. What's going to happen next? Interestingly, that doesn't know what's going to happen next either. They know what happened in the past.
Right.
And the only thing that I can do is I could put all of the probabilities into place. But what empowered me, Jay, many, many years ago, when I finally realized I don't know the future and nobody else does.
Right.
So, what if I start every morning with a small group of companies where each one of them, regardless of the industry they're in, have higher revenues, higher margins, higher cash flow, and all these 19 fundamental factors that we identified? If that's true, then normally I don't even care who is in the White House. I don't care about a lot of things. I
Mm-hmm.
just want to own those companies that are better than other companies. And the trick of this, Jay, is that just like athletes, most companies die.
Mm-hmm.
Okay. And you look at companies like Bethlehem Steel, which was the biggest steel company, or Pan America, or most of the people who are trading stocks right now, Jay, never heard of Woolworths.
Mm-hmm.
Forget about Sears,
Right. Right.
So companies come and go. And like an athlete, when their bat speed slows down, when their average slows down, the hardest thing for some individuals is to say, I don't want to sell that stock. I mean, I've been around that stock for years and years. But once they turn from mature to decay, they're not in my portfolio. End of story.
Right. Right. Wow, that's great. Back during the Peter Lynch days. I mean, that Peter Lynch and Woolworth and all the different people. He was with Fidelity. I remember that back in the 80s, 90s. And so let me ask you: is I have all my notes here. Something about FACTS, the FACTS model. It
Oh,
blends financial stability with governance metrics to access public. Is that the same thing, or are we talking about the same? Is that totally
So
different?
let me tell you, oh, Jay, such a great. So thank you for that lead in. So here's what happened, right? I'm running Magnet back from, it's embarrassing to say, but before the turn of the century, and I'm running this in the 90s, and then all of a sudden, we all remember what we call the .com bust, and that was a bust. That was
Mm.
overvaluation of the pet.com, and people didn't care what they were paying, et cetera. What happened in '06 and '07, Jay, was very, very different. Okay.
Yeah.
And I was literally going on CNBC almost every week and talking about the markets. And at that time, you remember the financial institutions were coming unglued. And they would say things like, we're fully capitalized. We don't need any money. Everything's fine over here. And then over the weekend, they took dilutive capital and 5 billion here and 5 billion there, which sounds like smaller numbers now, but they would dilute the company.
Mm.
And then what would happen would be, I said to the guys at CNBC and I said to the guys at Fox, and I was going on both of them and so on. And I said, you guys are half the problem. What you're doing is you're focusing on all the bad companies, anyone that does anything bad, you focus on them. But the reality is that people are genuinely good, companies are genuinely trustworthy. What if I actually did some math to find the most trustworthy companies in America and focus on them? And they said, okay, big shot, give it a shot. And so when I had previously blended value, growth, and momentum where no one had done it, and people said it was a bad idea and you couldn't do it. What we did, Jay, is we went to a group of consultants and academics and so on, and we said, if we were trying to solve for trust, what would we look for? And words kept popping up like accountability
Mm-hmm.
and transparency and corporate governance. And these words kept showing up. Now, following Enron, WorldCom, and a lot of financial mismanagement, companies had shown up that would actually give you data or sell you data based on, is the government, is the board of governors, the board of directors, are they independent? Does the CEO vote on his own salary? Is there an independent commission on in set up, to do salaries? What's the turnover? There's all this kind of what we called extra fundamentals, extra data on
Mm-hmm.
companies. How conservative was their earnings reports? How transparent were they in their operations? Well, we took the same approach of blending those things together to what we call the most trustworthy companies in America. So the FACTS, the FJ,
Mm-hmm.
is actually all of Magnet, all the financials, and then we blend all the Magnet with accounting conservativeness and corporate governance and transparency, sustainability of operations. We came up with a new model called FACTS. It's over 13 years ago.
Wow.
And people said to me, how do you know this will work? And I said, I don't. What it is, it's mature, trustworthy magnet stocks. These are normally bigger companies than I'll allow into Magnet. We have all this financial data. And here we are later now, 13 years later, Jay, it's the only diversified index to be ahead of the S&P 500 for 13 years. And so we're also now running separately managed accounts where people can say, I like this mature company idea. They're a little bit bigger. It's more of the JP Morgans
Mm-hmm.
than some of the smaller mid cap stocks that come into Magnet. But both of these models are data driven. They're not a matter of me deciding someone's a good guy or a bad guy. This is third party hard data
Mm-hmm.
measuring independence of boards and lots of financial data that goes into it and what we call extra financial. So here's the thing, Jay. There were 2 years when the Magnet fund that I run had exceptional returns, some of the highest in the United States. But that only helped a few people.
Mm-hmm.
only help the investors in my clients. If we could actually help bring back trust into big businesses, that's my lifetime goal right now. That's what really I'm focused on. People would say, look, I love to invest in the stock market, but I just don't trust those companies. They're all out for themselves. It's not true. There's bad companies and there's good companies. And if you can invest in strong financial companies that have your back,
Mm-hmm.
man, that's what I'm doing right now. Two different models, Fax and Magnet, and we run data all day long, all week long with a very small team of data scientists. We don't know the future, but we really do believe that we know the best players on any given day in every given sector, and that's the way we approach investing.
Yeah, that's great. And you said your goal is to bring the trust back to people that invest in the stock market. Man, the stock market's going up. I mean, it's the S&P is, I don't know if it's higher than it's ever been right now. If it's come down a
Close,
little
real
bit,
close.
but man, it is there is so much money poured into the stock market. If you had a lot more trust, it would keep going up, and it would seem like these stocks wouldn't necessarily be favorable, or would we need more stocks in the market, or you know what I'm saying? I mean, it's like there's only so many stocks, and
I
there's
get you.
yeah, and the
But,
stock,
but here's the point, Jay. But
yeah,
but but he, even though I agree 100% with you about valuations got high because a lot of money's been pushed into the market. But you know what, Jay? There's a lot of the public that have no money in the stock market.
yeah,
None at all. And they just don't believe in and what you hear about is when someone says something on TV or you see all these tremendous trust busting events going on at companies. So the thing is that we're just saying that if you make a product, the public actually cares about two things. Does the product work? Do I like the product? And how is it being made? Not so much this, green wokeism, because I don't believe in that. But the issue is that there are and there has been, and when you look at studies, there is a tremendous distrust
mm-hmm,
of large companies and of Wall Street.
mm-hmm,
And we need to bring that back. We need to have the individual feel comfortable in dollar cost averaging into mutual funds and building wealth over time.
yeah,
So, yes, the market's high. My goal is to kind of by highlighting what the best companies are doing, how they're doing it, what their programs are. Clearly, if they're actually outperforming the market, other businesses are going to look at that and
right,
say, maybe we should try that too. Maybe we should take things a step further and have employees who love it here rather than begrudgingly take a paycheck and can't wait to leave on Friday.
yeah. I, I I can see it. I mean, I can see there's a lot of companies out there, and they get into the ups and downs of what's going on in the markets, and they can't get capital, or their assets not as good as they thought, or it's not the Heinz 57 model, which has been great over and over and over again forever. But you have now. Let me ask you this. I mean, emotions is that the number one fact, I guess, or the number one reason why people lose money in the markets is because of emotions.
It's 100%. It's this fear and this greed it's talked about often, but the whole idea is that if you were to focus, Jay, on page one, how can you be a long-term investor? I mean, it looks like the world's coming unglued. It looks,
Right.
all kinds of scary things pop up. And then you see something like right now, quantum computer stocks start to fly. Now, I know a little about quantum computers and they don't exist and they
Mm-hmm.
won't exist for a while. And yet a lot of money will pour into them over the last couple of months. Why? Because they were going up, not because there was any value, not because there was anything really behind them. So
Yeah.
people will use both fear and greed against themselves. And I'll tell you a funny story, Jay, if I can. So years and years ago, when I got married, it's about 1990-ish, and my father-in-law said to me, "Look, you know a lot of what's going on in the market, and blah blah blah, and this and that." And he said to me, but Jordan, we're going to go to war right now with Saddam Hussein. And Saddam Hussein, they have the world's fourth most powerful government in the world. And I just don't feel comfortable in the market. And I said to him, I'm not managing your money anyway. Go to your mutual fund provider and tell them that you're not comfortable in the market and you'd like to go to cash. And when you want to get out of cash, all you have to do is call back that 800 number and get back in the market when you're comfortable. And so he did that. And Jay, he sat in cash for the rest of his life from 1990. And the Dow Jones was trading around 2000 then.
Wow.
And he just never got back in. He was afraid to be in the market because what was going on page one. And there's some really great research that shows like the price of stamps from a penny to two to three to four to 10
Oh
to
yeah.
whatever they are
Yeah.
now. And in the discussion was there was always a reason to be afraid to be in the market on any given year.
Mm-hmm.
And so what you have to understand is the sun will come up, companies will exist, there will be an NFL, there will be star players in the NFL, Major League Baseball. If you could identify them through data as the best players, man, go fishing, go boating, go golfing, do whatever you want. Just don't overthink it.
Mm-hmm.
Owning the best companies in America is the way to prosperity, period. And the emotions will always fight you each step of the way.
Yeah.
So, mathematical quantitative screening identifies the best. And then all you have to really do, Jay, is say, every player is going to retire. Every tree is going to die. When I see on any given season the leaves are not coming back on that
Mm-hmm.
tree, something's changed, right?
Right.
And I know that tree won't be around forever. So it's just a matter of being current, using my current spreadsheets and say who's the best in every industry and have a little bit. I like to have portfolios where the best from each sector and each market cap are in our clients' accounts.
Mm-hmm. Yeah, that's good. That's good. I was just thinking about that for a minute ago. You said something about making the decision, and your father-in-law never decided to get back in. But I was thinking earlier when you were talking about your story and you're 8 years old, buying Heinz 57, and you're picking stocks when you're in junior high, high school, college, and you have to make these decisions, but you also have to make that decision. I'm going to buy, and I guess the good thing about the stock market is you can buy and sell it, the same second if you really wanted to, and if you got scared. But you can. But at least you made that decision to go ahead. And I'm just sitting here thinking about it, going, you're not going to find the top 10%, 20%. Obviously, if you can be in the top 10 or 20% in dollar cost average and just keep going in year after year after year, that's probably a pretty good philosophy. But hey, I don't know if I want to pick stocks. I mean, I got to look through my value line magazines that I've got, and all that. And do you manage money, or have you thought about managing money, or how does if I wanted
That's
to
what I
do
do for
that?
a living. So that's what I do for a living.
Okay.
And of course, we manage money and we manage both private and public money. And so there are managed accounts. But going back to what you said here, Jay, it's super, super important. Um, when I was in high school, I didn't have the magnet stock selection process. This whole thing developed, right after college with Dr. Owen Carroll helped building it. But here's the thing I want to get back to in my book behind me, uh, what I say is that for most people, Jay, let's be serious. For most people, they don't have the time, the energy, the intellect, or they also don't have tens and twenties of thousands of dollars to pay for data and a team to pull it together. For most people, and I really mean this for most people, dollar cost averaging into a low cost index fund
Mm-hmm.
is the way to go. You got to start early, and no matter what's happening in the world news, you have to add a little bit and add a little bit. And this is what I told my sons. You don't have to be all about individual stocks. If you can find a couple good ones, that's great, and you let them mature and grow and compound over time. For most people, just getting started, index funds are fine. Maybe you add a stock onto that. But let me bring you one more thing, and comes down to experience. That you're right, Jay, that you could buy and sell a stock in any given moment and be in and out literally in the same exact minute. The hard part is making the decision. So what I tell people to do is, rather than this incredible drum roll in your head, should I or shouldn't I? Should I or shouldn't I? If you were going to put, say, $5,000 into an individual company that you came across, that you did your research, you're comfortable with, buy $1,000. Just get started.
Mm-hmm.
And then buy a little bit more months later, give it some time, watch it trade, watch the financials. So I don't know if you know the name. It's a colorful name. Do you know the name, Jay? Uh, Stanley Druckenmiller?
No.
Okay, so
No.
Stanley Druckenmiller has about the top performance of anyone in the country for the last 30 years.
Wow.
He came up with this concept called invest and then investigate.
Wow.
Interesting. He inverted it.
Yeah.
So if you see something you really, 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 really like, and something you're really, really interested in, or something begins to make news, don't hesitate. Buy a fifth of it, buy a tenth of it, for goodness sakes.
Yeah.
And then as it starts to go up, you could either cut your losses or you could add to it. But this concept where I have become emotionally free to literally come across a stock, see the ranking, see what they do. I jump on the website to see where was their management previously, what did they do, what did they accomplish,
Mm-hmm.
what are their products. I could buy that stock literally within 3 minutes because I've already done the ranking on it. I've already seen its rank.
Right.
And then I start small, though. I don't take the full position. I take a fifth of the position and then I add. If something comes out that I was wrong, uh, the whole idea is I'd never feel bad about losing money on a stock as long as I don't lose a lot.
Right.
It's all a matter of keeping your losses short. And then once you do identify something that works, you let it grow and flower and bloom and reflower and rebloom. And then you look 5 and 10 years later, you can't believe the size of that asset that you started on years ago.
Right. Right. But you also have a fund. So if I wanted to invest, if I want to invest with you right now, you probably take a management fee or something, a small management fee, and then I could open an account with your firm. Is that what's the name of the firm, and what?
So I have two businesses. I have two businesses. In fairness, the thing called the Magnet Fund is what's called the Reg D. I know you do Reg D offerings yourself. It's
Mm-hmm.
for accredited investors only, and we can't solicit it. So I don't want to get in any trouble here.
Right.
Everybody knows somebody. It's a word of mouth. People could be referred to it, and there's a high minimum. And most people don't invest with me like that. What we also have, though, are what are called individual managed accounts that are at a major brokerage firm, which I advise on.
Mm-hmm.
And those accounts, you could see every single night. You see every buy, you see every sell. There's just a small management fee. And we run both what we call Magnet, we run Facts, and then we actually run a third model called the All-Star Team, where I take the top companies from every sector, market cap, and with our team, it's only about 25 companies. So
Right.
it's both diversified but concentrated. So it's managed accounts. And then after people get to know me after a couple of years and we have a relationship, if investing with me where you don't see what you own on any given day, which for most people it's not comfortable.
Mm-hmm.
That's my private fund. That's where my money is. And that's where people that know me for a while are. But the managed account is the easiest way to get started. It's that, again, everyone knows the name of the brokerage firm, everyone knows the platform, and you see your account with your own security every single night.
How much does it take to get started on that? In that?
Uh it sounds, it's $150,000, just enough
Okay.
that we could buy into each company.
Okay.
And so most people start a little bit higher, but 150,000 allows us to buy all 25. And then It's a simple management fee. There are no commissions to buy and sell. The whole industry's changed. So we're not motivated to buy and sell to get fees. It's a
Right.
matter of planting the best trees and trying to hold on to your portfolio as best you can.
Right. Okay. No, that's good. I like that. I mean, I like the idea of we make more money when you make money type. I know it's Fisher
That's the
Investments,
way
and
it works.
my neighbor,
That's the way it should work.
my neighbor's in the sea level of Fisher, but when you have a management fee like that, that's right. I mean, the old days when I got my license back in the '80s, and also bought Eli Lilly back in the day. I sold
For
it.
you.
I sold it a long time ago too,
Okay.
but they came out with some new
It's okay.
drug, and I was sitting there next to my terminal, and it goes, "Oh, Eli Lilly," and it was, I don't know what the stock price was, 1988, 89, but
Yeah.
anyway,
Yeah.
they came out with some new drug, and they'd never been heard of before, and I wish I'd have just said, "Hey, you know what? I don't even think about it. Just kind of put it away, and don't even." I bet that stock has made so much money, it's unbelievable.
It's
So
been it's
that's
been
good.
great, but here's the thing, Jay, is like, if you just took it all the way back to trying to run a farm
Hmm.
or run a garden yourself, when you have something that's growing and growing, and Jack should never cut down the beanstalk,
Right.
right? Let it flower, let it flower, let it grow, let it grow. And I had a client years ago when I was selling muni bonds, Jay. He said to me, Jordan, I got most things wrong. I only got a couple things in my whole life right. And that's kind of the funny part of it, Jay, is you don't have to get a lot right. You just have to identify a company that's in an industry that's going to grow and stay in business over time and be one of the leaders in that industry. So I'll tell you a real quick funny story from a guy down in, your way, a relationship of mine, one of the hardest working, smartest guys I know. He said to me, my son, lazy, can't get him to do anything. He's just so lazy. And I said, lazy? Your son out of your stock, how could he be lazy? And he said, well, 30 years ago, he put a bunch of money into Microsoft, never sold it, never sold it.
Oh my goodness.
He says he's got some sort of net worth and, 30, $40 million of Microsoft stock.
Oh my gosh.
Whenever he wants anything, he just sells a couple shares.
Hmm.
He says, like, the guy's so lazy, I can't even get him to work anymore. And I said, hey, man, I heard of worse stories, and the guy deserves to be as lazy as he feels like.
Oh my goodness. Absolutely. 100%. I mean, there's a lot of people out there that got in on, Bezos, Amazon stock when they first came out, and he was raising $1 million at $100,000 a pop, and those
Mm-hmm.
people are billionaires today. There's a lot of great success stories, and I'm assuming that one of the key things about the stock market or a fund, as you run, which we need to look more into that later on, but or I offsite or offline we can do that. But I think it's an incredible idea, and you've got some great philosophies on what you do. But I think it's more about cutting your losses and letting your upside just kind of keep running. If there's good upside, I mean, just let it run. But if there's losses, if things aren't looking like that's what you, instead of putting all your money, put a fifth of the money and just kind of cutting your losses and moving on. I think that's a great way to be.
Well, Jay, I think you hit on probably the single most important thing that there is to cut your losses.
Yeah.
Because, all you need is one, two, or three real bad investments. And here's what happens, Jay. This is where the emotion comes down to. If I liked it at 30 and now it's 20, I might like it better. Now I like it better at 10. Now it's a one. It looks really cheap. I could buy a lot. And then it goes out of business,
Yeah.
and
Yeah.
then you're done. And so all your ideas and all your philosophies and everything can come undone with a couple of bad investments. Now, the reason I could share so strongly what I do, Jay, is I probably, at this age of my life, I've made most mistakes already. I have averaged down in a company before that I believed in. I believed in the management. Terrible mistake. I'll just never do it again.
Mm-hmm.
And so the whole idea is that just like you said, if you plant 10 seeds and 8 of them grow and 2 of them don't, the ego doesn't go back to those 2 seeds and make them try to grow.
Right.
You know intellectually, bad seeds, let's just remove them and plant something else and let the good stuff grow. If you could just do that and keep your emotions out and then start with the best companies, understanding that every athlete, uh, back in the old days, Joe Namath, I was a huge Joe Namath fan.
Mm,
You would not want him in your lineup anymore. You wouldn't want all these people, Joe Montana, all of them get old and replaced.
right.
And if you could just take that philosophy of saying, I'm going to take a lot of my judgment and opinion out, I'm going to remove my fear and my greed, and I'm
Right.
going to be very, very data driven and unemotional. I make mistakes, Jay, every week and every month still. I lose patience with something and then it starts to grow or whatever happens.
Right.
Don't think for a minute that any professional, including the best, doesn't make some mistakes. The difference is like a chess game, nobody wins their first chess game, no matter how smart they are. If you play long enough against better and better competition, 20, 30, 40 years later, you become pretty proficient at what you do. And it's just a matter of not being afraid to throw the ball, make a play, make a call, see what happens, cut your losses, and let your winners run. Uh, I just love what I do. It's a gigantic puzzle that
Hmm.
never ends.
Yeah.
And I have a small group of teammates that study and watch the data like I do, and make sure we see things that I don't.
Yeah. That's awesome. I think one of the big things. Well, so back in the dot com, you mentioned the dot com era, and I thought I was Peter Lynch or Warren Buffett back in the day, and we started with a portfolio and ran it up to a couple $100,000, ran it up to 1.7 million within a 6 months period. I mean, it went
Fantastic.
straight. I mean, just wow, up, and then the dot com thing happened, and then exactly Nanogen. If it looked good at 80, it's at 40. We're doubling down. I mean, it's like a slot machine in a casino because slot machine in a casino, it you put your money in, and all of a sudden you lose 2 times, but you win once, and so you feel good about the win, and you're like, oh, hey, here we are, man, this is it. And same thing with that. I mean, but my portfolio got so bad, and it went down so much, like 1.7 million to 30, 40 grand or something. I was getting my statements. I was getting my statements, and I look, and I wouldn't even open it up. I just go, okay, I throw
Yeah,
I throw
it's
it in the
textbook,
corner.
Jay.
Yeah,
It's textbook. What
emotions,
you're talking about.
emotions, and some idiot like me. No, just but somebody that just doesn't understand the stock market, and that's what having somebody like you that will take a fee, and your whatever your fee is. I don't know if you want to say it online, but if you want to say, hey, whatever you charge, you're going to make that a lot more in the future based on whatever the deal. If you charge 1%, 2%,
Yeah, one and a half, depending on the size. If the account's big enough, it's just 1%, but one
yep,
and a half includes literally everything. No account opening, no account closing charges, no fees, no trading fees. But yeah, no, I feel like it's incredibly. I bring a tremendous amount of value. But Jay, let me bring something else out, just in terms of intellect. And yeah, I went to Bronx High School of Science, and I have a master's degree in math and so on. But here's the thing. Albert Einstein felt the stock market was incredibly difficult. Okay. And there's great examples of Mark Twain losing all his money in the stock market. So really, really smart people, intellectual people. It's not really what it comes down to. I'll go back to uh, another character from the past, which is Will Rogers. Will Rogers was a cowboy.
hmm.
You know the name Will Rogers?
Oh yeah, oh yeah,
So he was a cowboy, he's a humorist, But what happened was he would say his expression, Jay, was all stocks are bad, all of them. I only buy the ones that go up. And when they stop going up, I get off. And so he was a horseman. And if you think about horses for a minute, horses have a finite life. Um, and once a horse can no longer run and gallop and so on, you might be a horse lover and keep them on your farm for the rest of their lives, but you don't run them anymore. And
Mm-hmm.
so it was the common sense of Will Rogers saying, all stocks are bad. And you want to hear the funniest part? We show in the books behind us. Before we even consider a stock and we do the math, we say, does the revenue growth equal this? Does the margin growth equal that? 95% of all companies are eliminated. And then we have a small pool to look at to do a little bit more research. But once they stop going up, we get off.
Hmm.
And it's a really hard concept to understand, but intellectually, it should make a lot of sense. And just like the All-Star game is played in every sport in, every year, we want to have just the best players in every segment that we work in. And then, like you said before a minute ago, you let the winners take care of themselves. As long as there's not a lot of bad bones in there, and there's not a lot of bad companies that haven't been whittled out already, you're going to make a lot of money in the market over time, I believe.
Yeah, yeah, yeah. I agree. It's like if there's no, it's like Apple stock continues to come out with new products and sales, and it's different, than some companies that won't grow as fast, or there's. Okay, now tell me this, and we got to stop with this one, but
Okay.
I was in I was in Boca Raton, and Brian Sullivan was there. You know Brian, and
I know Brian.
CNBC, great guy, and
Good guy.
all of a sudden that morning he spoke that morning, and DeepSeek, Nvidia had just gotten slammed, and he was asking everybody, hey, do you ever heard of this deep whatever it is, and everybody
Yep.
understand what's going on with the markets and everything. So how do you play into something like that with your decision and your Peter Lynch Warren? I don't mean to call it bad. It's a good thing when I say Peter Lynch, Warren Buffett. You're
Yes, it
studying
is.
stocks. I mean, you're
Yes, it
hyper
is.
focused, but then you get something like this. And I don't know if Nvidia. I thought Nvidia was overpriced. Going into the deal, because they've grown so much so fast. I don't know how anybody could be worth that kind of money so quick. But I don't know. Just kind of talk about the unforeseen activities that you could have, and what could happen, and how do you mitigate risk going into something like that?
Wow. What a question that is. So the answer is, I think it's still pretty simple. If you are leveraged and you are on margin and you own too much of one thing, Jay, bad things can happen to really good investors. Okay. And it's all a matter of margin of safety. It's a matter of some diversification. I'm not a real believer in very large diversification, but I also know you don't want to have your money all in one place.
Mm-hmm.
The idea is that, I'll go out on the limb here with NVIDIA. Uh, Once you get, it doesn't matter, you could just substitute the name of the stock for another one. Once the entire street and everyone's talking about the same name, it's too late, it's overpriced,
Mm-hmm.
and the action already happened. And so NVIDIA is and continues to be overpriced. It continues to be a leader, but there's a question of what do you pay for, any given thing. And so, hey, this is the hardest part because I am not going to tell you stocks are not risky. I'm not going to tell you you should have more money in the stock market than you feel comfortable with. It's a matter of sleeping at night. And then when a situation comes your way, if you overown it, if you have too much in it, you have
Mm-hmm.
no choice but to actually start to sell it. And Warren Buffett has said, believe it or not, three times during Berkshire Hathaway's run, three times the account went down more than 50%.
Wow.
We all know Warren Buffett's the greatest.
Right.
3 times his portfolio dropped 50%. If he was on margin, Jay, he would be at zero.
Right.
So it's a matter of not taking too much risk. It's a matter of sometimes, just like buying a third and buying a half or buying a fifth, news comes out, maybe just too scary for your blood. You don't have to freeze. You could sell a fifth. Then you could sell another fifth. And then suddenly your emotions fine. The whole idea is that in anything you do, whether you're playing sports, you're golfing, whether you're investing or operating in an operating room,
Mm-hmm.
it's the anxiety, the nervousness, the fear that makes people bunch up and operate poorly. So if you can, you breathe, you learn how to take things in stride. And some days, Jay, to be clear, someday you get the bear, someday the bear gets you. The
Yeah.
secret of investing is to be there next week, next year, have your ammo ready, and not get caught leveraged, over concentrated. Um, and you can make much better decisions if you one of the secrets about dollar cost averaging we touched on earlier, start young,
Mm-hmm.
is I'm going to put up a slide in the money show tomorrow or next week. It will show a guy saying, I haven't saved a nickel. I'm retiring on Friday. This is your chance to become a legend.
Wow.
Uh, no, thank you. I don't want to know that person. You have to start. You have to start
Yeah.
a little early, and that's the message. It's a
Wow.
tough business. Let me say this, Jay. If it was as easy as making a pie or making a sandwich, everybody would be a millionaire.
Mm-hmm.
Everyone would be a billionaire.
Mm-hmm.
It's hard work, and I'd suggest I like my books. In the books, I have a bibliography in the back. I encourage you to read more. Read as much as you can. Get started early. And Jay, every trade presents experience for you. The more experience you have, just like that chess game, you're going to win more games than you did as a kid. And then suddenly you become a chess master, and you have to just stay humble, and not take too much risk on any given day.
Right. Right. God, it sounds so good. That sounds really good. Well, I thought about asking you about Bitcoin and because because there are some stocks that you can invest in, just like I own one called BTCO because people want me to take money out of my stock portfolio and put it in some lock and key Bitcoin, and I'm like, I don't like that idea because what if I lose my keys, or what
Right.
if I did that?
Yeah.
But I can invest in Bitcoin in these other type of vehicles. But any of your portfolio in Bitcoin, or you look at it or understand it?
So you're asking one of the funniest questions, and so let me be as clear as possible. I blew it. I never put a dime into Bitcoin. I'll tell you why. I would speak at these conferences for years and years. And at the end of the conference, Jay, I would always be approached by some kind of really sweaty looking dude who, in a bad suit, would say, I talked to you about Bitcoin.
Mm,
And I'd say, who are you? Like, where are you from? Who are you with? And they'd invariably say, well, we've been disbarred from the industry, but there's this thing, Bitcoin. We want to talk to you about it. And I just said no. I said no each time. So the answer is I don't have a penny in Bitcoin. It was a mistake of mine, and calling me stubborn, and should there be a gigantic sell off in it, and it begins to make sense. But for now, I'm going to be in things that pay some dividends, plays. I'm not a real big dividend guy, but I'm all about companies with revenues and margins and earnings, and they
yeah.
do something. I never got Bitcoin. I wish I had a better teacher and mentor 15 years ago, because I saw it at $10 and $20, and I say it's 100,000 now.
Yeah.
Um, and I laugh at myself, but you can't do everything. You can't be an expert in anything. I do not trade commodities. I do not trade in currencies. I know where my strengths are, and I stick with my strength.
Yeah. That's great. That's great. That's awesome. So let me ask you this. So if one of our listeners is in with an RA already, let's say, and he's got his money into
Sure.
whatever the big brokerage, Charles Schwab or Fidelity, whatever, and they wanted to, can you do a fund of funds where my portfolio is already with my guy here, and then I can do, let's just think about me for an example, and then can I invest in you in your fund, or do I have to take my money out of my deal and put it? Is there only one way to do it? Or is
Yeah,
there?
no, unfortunately, Jay, you'd have to have your money over at the firm where we're at. Just so you know, the firm is Schwab. That's
Mm-hmm.
where lots and lots of advisors have their money. So
Mm-hmm.
it's the Schwab platform. And then all you'd have to do with money at Schwab is point to Jordan Kimmel, point to brokerage firm that's running the models. The account is in your name, but no, we don't work with a fund to fund things. And let me just say that the tag's a little long, but Magnet Investing, and then we said let's do MagnetInvestingInsights.com.
Mm-hmm.
And if you go to MagnetInvestingInsights.com, there's a page for contact, and just ask for a phone call, ask for a meeting. And we like to lift the veil as high as we can. Again, transparency of operations is the most important thing when it comes to investing, and things like SIPC insurance, and having it at a major brokerage firm where everyone can sleep at night. And then on any given day, close the account if they felt like it. That's the way we operate.
Yeah, that's great, Jordan. I'll tell you what, it's been a pleasure meeting you and listening to your story. Extraordinary story, talking about the stock market. I mean, you definitely are a believer in the stock market. You've seen the ups and downs. Like you said, you made mistakes, but you made more good decisions than bad. I don't know about that. You probably made more bad decisions than good, but the good ones took care of the bad. Maybe is that how you say
Exactly
that?
right. That's exactly the way it clears
Yeah.
out. And I want to just mention one other thing, just because the industry that you're in, and
Yeah.
before we jump off here. So the Money Show says give just two stocks, uh, give me two companies for the whole year that you would be comfortable, sharing. And one of them is an oil and gas company. I don't know if you know the name, Technip, FMC, TF. It's FTI. I'm not making a recommendation on your show. It's the highest ranked magnet oil and gas uh, enabler, I guess.
Wow.
They're selling equipment. You might know the name. Do you know the name?
No, I don't. F. What's the stock symbol again? Let me look.
Frank Thomas Indigo.
Okay.
It's
FTI.
not a recommend. Yeah, it's not a recommendation for everyone to go and buy today. Everyone's got their own things, but all I'm saying is that your industry, I'm not going to bet that the price of gas and oil is going to be higher, but the expression drill baby drill. We're going to hear it for years, and companies that help companies drill
Mm-hmm.
and explore are in the cat seat. So I just share that one with you, Jay, because I
Okay.
know your industry,
Yeah. Yeah. No, that's
and
good.
I wanted to make it a little homey.
No, that's good. I appreciate that, and I'll look into it. $31 a share right now. Uh, anyway, they're selling a good company, but that I guess that is the best out of the 19 different metrics that you use to measure a stock with everything. That's the best one. That you said that's the best one in your portfolio.
In that sector, and it all comes down, Jay. Let me just say this: you run a business. I know that if you don't have revenue growth,
Mm-hmm.
everything falls apart. You can
Right.
only cut costs so much. So the primary driver behind every company I invest in is top line revenue growth. And without that, you can't even make my portfolio, no matter how good your story is. We're going to find something, we're going to develop something, we're going to learn. None of that counts. I'm into operations, revenues,
Right.
cash flow, margins.
I love it.
And if you're better than everybody else in your industry, you're probably going to be a pretty good investment for
Right.
now.
That's great. And you're right. I mean, I've been running companies or our company for a long time, and all, everything matters is revenue, right? It's more about revenue than it is about cutting costs, and it's kind of like the. I mean, I think the government's finally deciding. Oh, hey, wait a minute, we raised taxes for so long, and we can only do so much. But why don't we cut expenses? So I know that's a different thing, but I was reading about that this morning. A lot of Elon Musk in the news, and a lot of DOGE and all that. Man, I tell you what. But yeah, you're right. Revenues is great, and it's better to have revenues or to over. If you can do a lot of things as long as you have revenues, but there's a lot of things you can't do if you don't have revenues. So that's good. I
That's
love that.
exactly right.
But
Right.
but anyway, marketinvestinginsights.com. Man, Jordan, Magnet. Yeah.
Magnet. The whole concept here, Jay, is
Yeah.
like, let me just share
Yep.
this. These companies, FTI, every company in my portfolio, they act as magnets to larger institutions because when everyone else is getting the same data I'm
Right.
getting, when you see that revenue growth and margin growth, I think our secret is we created a couple ratios that get us in a little bit ahead of the game. So it's this value growth and momentum.
Mm-hmm.
But yeah, so it's MagnetInvestingInsights.com. There's a bunch of videos up there from the television shows. But the main thing, it's not a matter of being a TV guy. It's a matter of doing the work every morning, every day, every week with a team to identify simply which companies are on the come up, which companies are on the roll over, and try to hold these companies for a couple years at a time,
Right.
and let them just compound for you.
Right. Right. That's great. I mean, I love that. I mean, my great grandfather's in the oil business, and my grandfather on my dad's side was in the oil business, but my granddad on my mom's side loved the stock market. He read the Kiplinger, made sure that I had a copy of it, which I never read, but I did read it sometimes, but because he'd go over it with me and ask me, and he was the Wall Street Journal, loved the stock market, loved gold, that kind of stuff. But I tell you, it's really good to meet you and to have your insight, magnet insight, but having your insight into this because you've done an incredible job on learning this. Now I got to ask a question. I got to ask a question for Jordan because
Go for it.
Jordan Soto's my co-host and she couldn't be here today, and I know that she would want to ask you if you could tell your 18-year-old self something. What would that be? What would if you looked at your 18-year-old self, or what are you telling your grandkids now, or whatever at 18? What would that be? We've got a lot of good stuff about you, but is there anything in particular you would do different?
Yeah, well, here's what I'd say. It's a matter of who you do business with. The hard part to admit in the financial industry, there's a lot of charlatans, there's a lot of shortcutters, there's a lot of me first people.
Mm-hmm.
And I've got into certain partnerships with people that look larger than life, that had great reputations, that turned out to have feet of clay. And it turns out that who you do business with is one of the most important things in your life. It's like a spouse. Those things mean more than most anything else. So it's a matter of not taking shortcuts. Hard work pays off, and if you see people around you taking shortcuts, take off.
Right, right. Yeah, take off and don't. Yeah, because there's people out there that aren't going to change their stripes, or if they do, it takes them forever. And why waste time? So you're all about networking. You're all about having the people around you that are good for your business, good for your, good for you. So that's awesome. That's awesome. Is there anything
Quality,
else?
Jay. But
Yeah.
let me just say this. But I know
Yeah.
we're looking to bump against time here. But I'll say this.
Yeah.
Again, I would tell employees when they started with me, we all make mistakes.
Mm-hmm.
Every one of us makes a mistake. Never ever hide a mistake because my father used to say it's like a toothache. They come back bigger in the middle of the night. But the whole idea is that never hide a mistake, and You can make mistake after mistake. Try not to make the same ones. If you're ever caught lying, it's your last day at the firm.
Yeah. Yeah.
And
Definitely.
so integrity and this kind of helped me bring this magnet model all the way up to the fax model. And it's a matter of integrity. Do what you say what you mean. And the biggest mistake that I look back on, there were a lot of people that wasted years of my life telling me this or that. And if someone gets caught lying, it's different to make a mistake. So that would be my answer, Jay. Make sure the quality of the people that you're with uh, is as high as possible.
Mm-hmm.
And when you work hard with good feedback and honest people, good things happen.
Yeah. That's awesome. That's great. I love that. I love that. We do. Man, I mean, that's true. You don't want to hang around people that are going to lie to you. You're some of the people that you hang around, obviously, and we've heard that, plenty. But and two, be around good people just grow those relationships, and the fruits will happen. You'll be there. You'll make
Yep,
money. You'll have great relationships. You'll have more fun, which that's what it's all about. So I'll
it
tell you
is.
what, go into MagnetInvestingInsights.com. Learn more about this guy. This guy's a legend. He's a legend. I can't wait to get off. I've already tried to during the time is try to put my phone in and try to look up your website and look at all the different things, and your story's magnificent. Extraordinary story about investing in stock market and staying with it, and the principles and being disciplined, and dollar cost averaging, starting sooner than later. Don't wait forever, because you'll be, like you said a minute ago, there's the guy that retires and has zero money, and he's just like, okay, now what? That's right. Yeah.
Make me a legend. Make yourself a legend by helping me. You can't help those people, but
Yeah.
I think we touched on a lot of great points, Jay. It's really my pleasure to have been on with you. And you know what? I don't think we'll be strangers. I know we're looking forward to learning more about your business, and I appreciate you exploring Magnet. I love the trajectory I took, and people say to me, "Why don't you retire?" Warren Buffett won't retire. I'll tell you one last thing
Yep.
in my book here. There was a portfolio manager I interviewed. He was 105, and he ran the largest, not the largest, the longest running mutual fund company in America. He said, Jordan, I will never, ever retire. Hey, this is actually a lot of fun what I do.
Yeah.
And it's a puzzle that intrigued me as a little kid, and we're still solving the puzzle today.
Wow. That's great.
Wow.
That's great. And I agree. I don't want to retire. People say, what am I going to do if I retire? Go home and watch CNBC. I guess I could watch you on CNBC and Fox and all these other places, but that's it. I want to be active, and everybody wants to be active in what they're doing,
No
but that's
doubt.
great. That's great, Jordan. I tell you, it's been a pleasure having you on the show. I do appreciate you being here. I can't wait to hear more about you in the future. I know I want to hear great things, and I wish I was going to Vegas this weekend to be or next week to be on the Money Show, and we're going to share the stage. We're going to share the stage soon, because I do want to
Yeah.
make sure that we stay connected. And if somebody's looking for another piece of a puzzle in your portfolio, don't put all your money in oil and gas. That's I'll tell you that 100%. Don't put all your money in oil and gas. Don't put all your money in the stock market. You got to diversify. Find good people. Find good people with good principles that are going to do that. And Jordan's definitely one that you could hang your hat on. I just met you, but I know from experience and knowing what I know about people and things, and obviously, doing more due diligence on your fund is at our fingertips these days. So, man, congratulations on I don't say a great career, because you're still in your career.
We're living it, man. I'm not done, man. I'm not done. I like where I am now, and I'll see you soon for sure.
Absolutely.
So, Jay, thanks for having me on your show, and I look forward to our very next conversation.
Great. That sounds great, Jordan. I look forward to it. Everybody, you heard Jordan here, and we appreciate him being on. So thanks, everybody.
My
and
pleasure.
see you again next week.
We'll see you soon.
Thank you.
My pleasure.